The issue with the start of this season is there was an expectation that it was going to be as strong. It's actually incrementally stronger than expected. But the reason the market hasn't gone, streaming through 7,000 on the S&P is that after the last several quarters, where you had surprises on the order of 6% or so above the baseline expectation, getting you to that double-digit number, we thought it would happen again. Okay. It is happening again. But the underlying message is it sets the table for 2026 very effectively.
Julian, starting late October, early November, we started to see a little bit of a rotation in the market. Maybe out of some of the tech names into some of the more value, maybe small and mid cap. Is that a longer term trend? Is that something we should play in 26? How do you think about that?
Well, from our point of view, it actually started when healthcare started to recoup the underperformance of the prior year when the government shut down the first time.
Okay.
I mean, I've lost track of the number of times the government shuts down. And then what you got toward the end of the year was the start of the rotation away from technology because you had some disappointment on earnings and you had concerns about debt. And then to start January, it's very typical for these areas to outperform the prior year's laggards. In our mind, it is one of those things that in projecting 7750 at year-end 2026 on the S&P 500, technology, because of the weighting in the index, the math drives the fact that it should, and in our mind, there's enough negative sentiment for the wall of worry to be overcome that it will regain the leadership.
So for tech to regain that leadership, is that simply a function of that's where the earnings are? That's where the cash flow growth is?
Well, it's that, but if you look at the last few weeks, it's also where the speculation has not been. Okay. So in fact, the fact that it's come off the boil in gold and silver is likely going to be a tailwind for technology.
Julian Emanuel, Evercore ISI with us, a lengthy conversation to get us started. We're on YouTube. Subscribe to Bloomberg Podcasts on YouTube, growing each and every day. We had some youngsters over. The kids had some youngsters. They're so hip.
Yeah, of course.
They don't do YouTube.
No?
They spent the whole time talking about Bruno Mars and the Grammys.
All right.
But, we're on YouTube. We're doing a digital distribution there. Tell me about revenues. I look at Pepsi. They're cutting prices on Cheetos and all that. There's a real battle here to sustain a nominal GDP revenue stream. Are we?
It's actually stunning, quite frankly, that revenue looks like it's going to come in north of 7% growth.
Blended S&P 500?
I mean, it's
you and I have never said that.
No, yeah, and it is really points to the extraordinary resilience of the economy, and frankly, again, this idea that as uncomfortable as it is when we see this affordability issue, the fact is that for now, and this is changing at the margin because of this kind of commentary, is that as long as the employment picture is as strong as it is, revenue can continue to be as strong as it is.
What do you see about use of free cash flow? I got a 4% dividend lift at Pepsi. They announced not an Apple-like share buyback, but nevertheless, are non-tech companies getting like Apple, where they're trying to really deploy cash to shareholders?
No, and that's an ongoing trend, but accelerating again, because when you look at 2026, what you see is a macro backdrop where you're going to have, stimulus via the One Big Beautiful Bill. You're going to have stimulus via 2, maybe 3 Fed rate cuts. And so you really don't need to have the war chest ready, as corporate America does from time to time, in anticipation of a market slowdown.
Boy, Tom, I'm looking at another big tech name, Palantir Technologies, forecast revenue for fiscal 26. That's expected to grow 61% this year. Holy cow. Yeah. So it stocks up 11%.
Dan Ives has been on that, hasn't he? I don't even know what they do.
No,
I mean, I'm in the triple leveraged all cash fund, so who cares? But I look at folks, I'm not going to mention the name of the company, but I got a bellwether toothpaste company that I just sort of use. Paul, it's popped in like 2 weeks up 20%.
Yeah.
A boring toothpaste company.
Yeah, a little rotation there, but
because rotation, and also I think use of cash.
Yep. Julian, we saw 2025 U.S. equity markets did very, very well, but many markets outside of the U.S. did way better than the U.S. How do you think about the U.S. versus rest of the world from
So that actually goes back to Tom's last observation on the toothpaste company. Part of that was the fact that the U.S. dollar has fallen as far as it has over the last year. And that, Paul, has driven a lot of this outperformance of the rest of the world. You know, in our mind, the dollar did make a significant multi-year peak last year at about this time, similar to you had a multi-year dollar downtrend from 2001 to 2007. And the bottom line there, and we think the bottom line over the longer term here, is that you saw rest of world outperformance over that long period because of the dollar weakness. Now, what we would say here is that it is not likely that you're going to have a dramatic rest of the world outperformance kick in until the AI trade peaks. And, we believe the AI trade has a lot further to run.
About just valuation in the market, how do you frame that conversation with your clients these days?
Well, the last year has been a transition, is that, most value-oriented investors had to make the leap of faith, as did we, into this idea that this is one of these times where valuations are higher than normal due to the potential for this productivity bump from AI, and due to the fact that there's just an enormous amount of liquidity in the system right now. And so it's put it this way. If we get to a point where people are no longer questioning valuations, that's when we're going to start worrying. We hope that time doesn't happen.